while the entire financial world is popping champagne corks over gold hitting $4,700 an ounce, while the mainstream media is finally running headlines about the golden age, a much bigger, much more violent story is brewing in the shadows. They want you looking at the all-time highs. They want you feeling that pang of regret, that fear of missing out, thinking you missed the boat because you didn't buy gold when it was $2,000. They want you chasing the train that has already left the station. But if you are chasing gold right now, you might be walking right into a trap. Not because gold is bad, gold is the king, but because the smart money, the billionaires who actually move the markets, are quietly closing their gold positions and rotating into something else. Two men who have predicted almost every major financial crash of the last 40 years have just sent up a flare. One of them just posted a price target that sounds absolutely insane to the average person. The other, a legendary investor who hates losing money, just admitted he is no longer buying the asset everyone loves. They are both pointing to the same asset, an asset that is currently ignored, unloved, and historically cheap. An asset that isn't just money, but the lifeblood of the modern economy. If you think the move in gold was impressive, you haven't seen anything yet. We are about to witness a catch-up trade that will create more millionaires in the next 12 months than Bitcoin did in the last 5 years. The target is $200, and the window to get in is closing. Welcome back to channel. Hit that subscribe button and turn on the bell. You cannot afford to be late to this info today. We are talking about the Billionaire Pivot. Why are Robert Kiyosaki and Jim Rogers, two investors with completely different styles, suddenly saying the exact same thing? And more importantly, what does the gold to silver ratio tell us about the future price of your portfolio? Before we dive in, I have a question for you. If you had $10,000 to invest today, right now, would you buy 2 ounces of gold or 100 ounces of silver? Put your answer in the comments below. 2 gold or 100 silver. I want to see where your head is at. Now, let's look at the signal that broke the internet. Yesterday, Robert Kiyosaki, the man who taught a generation about assets versus liabilities with Rich Dad Poor Dad, took 2X, formerly Twitter, and dropped a bomb. He didn't write a long thread. He didn't post a video. He just posted a number. He tweeted, "Silver breaks $80, $200 next." Now, the trolls came out immediately. They called him a broken record. But here is what they are missing. Kiyosaki isn't guessing. He is looking at the purchasing power of the dollar, and he is realizing that the dollar is evaporating. When he says $200 silver, he isn't saying silver is becoming expensive. He is saying the dollar is becoming worthless. But Kiyosaki is the loud one. We expect him to be loud. The reason I am making this video today is because of the quiet one. Jim Rogers. If you don't know Jim Rogers, you should. He co-founded the Quantum Fund with George Soros. He is known as the Indiana Jones of finance. He drove a motorcycle around the world. He buys markets that are left for dead. He bought commodities in the 90s when everyone was buying tech stocks. He made a fortune. Jim Rogers rarely changes his mind. He has owned gold for decades. He loves gold. But in a new interview that just surfaced, he said something that should make the hair on the back of your neck stand up. He said, "I am not buying gold right now. Gold is at all-time highs. I don't buy all-time highs. I buy what is cheap." And then he dropped the hammer. "I am buying silver. Silver is down 40% from its all-time high. It is the cheapest asset in history." Think about the discipline that takes. The whole world is screaming buy gold. The price is vertical. It feels good to buy gold right now because everyone else is doing it. But Rogers is saying, no. He is looking at the asset that is lagging. He is looking at the asset that is hated. Why? Because he knows how market cycles work. He knows that capital rotates. When gold gets too expensive, the money doesn't go back to cash. It flows into the next best alternative. It flows into the poor man's gold. Let's strip away the opinions and look at the cold, hard math. This is the part of the video where you need to pay close attention, because this calculation proves that $200 isn't a fantasy. It is a mathematical certainty if history repeats itself. It is called the gold to silver ratio, GSR. Simply put, this ratio asks, how many ounces of silver does it take to buy 1 ounce of gold? Geologically, in the Earth's crust, for every ounce of gold we find roughly 15 ounces of silver. That is nature's ratio, 15 to 1. For thousands of years of human history, The monetary ratio was set around 15 to 1 in 2011. During the last major precious metals bull market, the ratio tightened to 30 to 1. But right now, today, even with silver's recent rally, the ratio is sitting near 50 to 1. This is an anomaly. This is a glitch in the matrix. It means silver is priced as if it is 3 times more common than it actually is. Let's run the numbers based on today's gold price of $4,700. Scenario A. The conservative reversion. Let's say the ratio just goes back to where it was in 2011, 30 to 1. Not a historic low, just a recent low. We take the gold price of $4,700 and divide it by 30. That gives us a silver price of $156 per ounce. That is nearly double where we are sitting today, just to get back to normal. Scenario B. The historic reversion. Let's say the panic hits, the dollar collapses, the world goes back to hard money, and the ratio returns to its geological reality of 15 to 1. $4,700 divided by 15 equals $313 per ounce. Do you see what Kiyosaki is doing? When he tweets $200 next, he is actually being conservative. He is picking a number squarely in the middle of the conservative and historic scenarios. He is betting on reversion to the mean. In financial markets, rubber bands always snap back. The gold to silver ratio is a rubber band stretched to its absolute limit. When it snaps, it is going to take the face off anyone shorting this market. Now, the skeptics will say, but you can't just rely on ratios. Times have changed. You are right, times have changed, and they have changed in favor of silver. In 1980, when the Hunt brothers cornered the market and silver hit $50, silver was mostly used for photography and jewelry. If the price got too high, people just stopped taking photos or buying forks. Demand was elastic. Today, the world is completely different. Silver is the most conductive metal on the periodic table. You cannot have a modern economy without it. You cannot have an iPhone without silver. You cannot have a Tesla without silver. You cannot have a Tomahawk missile without silver. You cannot have a solar panel without silver. We are in a green energy revolution. Governments are mandating solar panels. They are mandating EV. Do you think a solar panel manufacturer cares if silver is $30 or $100? No. They need the metal to make the panel work. The cost of the silver is a fraction of the total cost, so they will pay any price to get it. This is called inelastic demand. And here is the scary part. We are running out. For the last 5 years, the world has consumed more silver than the miners have pulled out of the ground. The Silver Institute reports hundreds of millions of ounces in deficits. We are eating into the above-ground stockpiles. The warehouses in London, LBMA, and New York COMEX are bleeding inventory. They are scraping the bottom of the barrel. So, on one hand, you have Jim Rogers and the billionaires buying it as a monetary store of value. On the other hand, you have Apple, Samsung, and Tesla buying it because their businesses depend on it. Two massive forces fighting for a shrinking pile of metal. What happens to the price when two billionaires fight over the last Mona Lisa? It goes to infinity. There is one more factor that drives this to $200, and it has nothing to do with charts or supply chains. It has to do with human psychology. We are entering a phase of retail panic. The average guy on the street sees gold at $4,700. He feels poor. He wants to protect his savings, but he feels like he can't afford a gold coin. He looks at Bitcoin at $150,000 and feels priced out. Then he sees silver. He sees he can buy a whole ounce of real money for under $100. He thinks, if I buy gold, I get a tiny flake. If I buy silver, I get a heavy tube of coins. This is called unit bias, and it is powerful. When the masses rush in, they won't rush into gold. The door is too small. The price is too high. They will rush into silver. Because the silver market is so tiny compared to gold. It's like a bathtub compared to an ocean. When that tidal wave of retail money hits the silver market, the water level doesn't just rise, it explodes. We saw this with games. We saw this with Doge, but those were digital illusions. Imagine what happens when the Reddit crowd, the boomers, and the Gen Z investors all try to squeeze into the physical silver market at the same time. There simply is not enough metal to go around, and when you try to buy it, you will hear 3 words from your dealer: out of stock. So, what is the strategy? How do you play this without getting burned? Listen to me closely. This is the most important part of the video. Do not, I repeat, do not buy paper silver. Do not buy SLV. Do not buy unallocated accounts at a bank. Why? Because the paper market is rigged. For every ounce of real silver in the vault, there are hundreds of paper claims traded on Wall Street. When the price hits $200, the banks will not be able to deliver the metal. They will invoke force majeure your contract in cash at the old price, while the real metal trades on the black market for double or triple that amount. Jim Rogers buys physical. Robert Kiyosaki buys physical. They want the asset in their hand. If you don't hold it, you don't own it. You are going to see premiums skyrocket. You might see the spot price at $90, but the dealer wants $130 to sell you an eagle. Pay it, because the spot price is a lie. The real price is what you have to pay to get the metal in your hand. We are living through history, folks. The 40-year bull market in bonds is over. The era of easy money is over. The era of trusting the government to manage the currency is over. We are entering the era of hard assets. The era of show me the goods. Robert Kiyosaki and Jim Rogers are old men. They have seen it all. They don't need to hype anything to sell you a course. They are trying to warn you. They are telling you that the train is leaving the station. Gold was the first car. It's gone. Silver is the last car. And the conductor is blowing the whistle. You have a choice. You can sit there and watch the price tick up on your screen, arguing in the comments about whether it will hit $190 or $200. Or, you can take action. You can secure your position before the masses wake up. This is the greatest wealth transfer in human history. It is transferring from the paper blinded to the reality minded. Which one are you? If you found value in this deep dive, please smash that like button. It tells the YouTube algorithm that people want the truth, not just entertainment. Share this video with a friend who is sitting on cash. Wake them up before inflation eats their savings alive. Don't subscribe to Wealth On. We aren't going anywhere. We are going to ride this rocket all the way to $200 and beyond. Comment below. What will you buy first when silver hits $200? Real estate, land, or will you hold forever? Let me know your exit strategy. Stay sharp, stay stacked, and I'll see you in the next one.